Here's what most people approaching Medicare completely misunderstand, and it's costing them hundreds of dollars they'll never get back. The Medicare Part B deductible just increased to $283 for 2026, up from $257 last year. Now, that $26 increase alone isn't the real problem. The problem is what happens when people make one simple timing mistake that turns this into a permanent penalty they'll pay for the rest of their lives. See, I've spent decades studying human misjudgment, and there's a particular error I see people making with Medicare that violates every principle of rational decision making. They delay signing up for Part B when they're first eligible, and Medicare adds a 10% penalty to their monthly premium for each full 12-month period they wait. This isn't a one-time fee. This is permanent. If you delay enrollment for 7 years without qualifying employer coverage, your monthly premium becomes 70% higher for as long as you have Medicare. With the 2026 standard premium at $202.90 per month, that delay would cost you an extra $142 every single month, forever. Think about the compounding effect here. That's $1,104 per year in unnecessary costs. Over a 20-year retirement, you're looking at $34,080 in penalties, all because of one enrollment mistake. And here's what makes this particularly insidious. Most people don't even realize they're in the penalty window until it's too late. The psychology behind this mistake is fascinating. People see they have employer coverage and think, I'll deal with Medicare later. But the penalty clock starts ticking the moment your initial enrollment period ends, unless you have very specific creditable coverage. The rationalization feels reasonable, but the consequences are mathematically brutal. Now, what you need to understand is that there are legitimate exceptions. If you're still working at 65 with qualifying employer coverage, you can delay without penalty. But the moment that coverage ends, you have exactly 8 months to enroll, or the penalties begin accumulating forever. This is the kind of irreversible mistake that violates everything I believe about preserving capital and avoiding unnecessary costs. You cannot undo this penalty once it's applied. There's no appeal based on "I didn't know." Medicare doesn't care about your ignorance. The trap is built right into the system's complexity, and millions of Americans walk straight into it every year thinking they're being smart by waiting. They're not being smart, they're being penalized for life. Now let me walk you through exactly how this system works, because understanding the mechanics is the only way to avoid becoming another statistic. The Part B penalty structure is elegant in its brutality, which is what makes it so dangerous. When you turn 65, you enter what Medicare calls your initial enrollment period. This is a 7-month window that starts 3 months before your birthday month, includes your birthday month, and extends 3 months after. During this window, you can sign up for Medicare without any penalties whatsoever. Miss this window without qualifying coverage from an employer, and the penalties begin accumulating immediately. There's no grace period, no forgiveness, and no second chances. The mathematics of the penalty are straightforward but devastating. For every full 12-month period, you delay enrollment past your initial enrollment period. Medicare adds a 10% surcharge to your Part B premium. This means if you wait 2 years, your premium increases by 20%, 3 years, 30%. The penalty doesn't cap out. If you somehow manage to delay enrollment for 7 years without qualifying coverage, you'd be paying 70% more than the standard premium for the rest of your life. Think about what that means in practical terms. The standard Part B premium for 2026 is $202.90 per month. If you delayed 7 years, that 70% penalty adds $142.03 to your monthly premium, bringing your total to $344.93 every single month. That's an extra $1,704 per year. Over a 20-year retirement, that mistake costs you $34,080, and that's before we factor in future premium increases, which happen regularly. Here's where the psychology gets particularly interesting. Most people who fall into this trap aren't being cavalier about their health care. They're making what seems like a rational decision based on incomplete information. They're still working at 65, or their spouse is working, and they have employer coverage. They think, why would I sign up for Medicare and pay an additional premium when I already have insurance? It's a perfectly reasonable question. The problem is that the answer depends entirely on the specifics of your employer coverage, and most people don't understand the rules that determine whether they're protected or exposed. The key distinction is between qualifying employer coverage and everything else. If you're working at a company with 20 or more employees and you have health insurance through that employer, you can delay Medicare Part B enrollment without penalty. The same applies if your spouse is working at a company with 20 or more employees and you're covered under their plan. This is called a special enrollment period, and it gives you an 8-month window after your employment or coverage ends to sign up for Medicare without facing penalties. But here's the critical detail that trips people up. The coverage must be based on current employment at a company with 20 or more employees. COBRA coverage doesn't count. Retiree health plans don't count. Coverage from a small employer with fewer than 20 employees doesn't count. If you're relying on any of these types of coverage and you delay Medicare enrollment past your initial enrollment period, the penalty clock is ticking, and you won't even know it until you finally try to enroll. Let me give you a concrete example of how this plays out in real life. Say you retire at 66, 1 year after becoming Medicare eligible. Your employer offers 18 months of COBRA coverage, which seems generous. You think, perfect, I'll use COBRA for 18 months and then sign up for Medicare. You're making a 30% penalty mistake, and you won't discover it until you submit your Medicare application. Those 18 months of COBRA don't provide any protection against late enrollment penalties because COBRA isn't coverage based on current employment. The moment your employment ended, your 8-month special enrollment period started. When you finally enroll in Medicare after 18 months on COBRA, you've been without qualifying coverage for 10 months beyond your special enrollment period. That's nearly 1 full year of delay, triggering a 10% permanent surcharge on your Part B premium. The compounding problem here is that these penalties affect your premium in perpetuity, and premiums themselves increase over time. The Part B premium has risen significantly over the years. Back in 2015, the standard premium was $104.90. In 2026, it's $202.90. That's nearly a 94% increase over 11 years. Now imagine you're carrying a permanent 20 or 30% penalty on top of these base increases. The penalty doesn't just apply to today's premium, it applies to every future premium for as long as you have Medicare. This is what I mean when I talk about the compounding nature of mistakes. The error you make at 65 or 66 doesn't just cost you money today, it costs you exponentially more as time progresses and premiums rise. What makes this particularly insidious is how Medicare structures the information disclosure. When you first delay enrollment, nothing happens. There's no letter saying, "Warning, you're now in a penalty situation." There's no phone call from Social Security alerting you to the problem. The penalty only becomes apparent when you actually try to enroll in Medicare, which could be months or years after you've entered penalty territory. By that point, the damage is done and it's irreversible. You can appeal if you believe you had qualifying coverage that should have protected you, but if you genuinely didn't have that coverage, there's no appeals process that will save you. The penalty is permanent, and it starts immediately upon enrollment. Now let's talk about Part D, because the prescription drug coverage penalty operates on slightly different principles, but with equally permanent consequences. Part D has what Medicare calls a continuous coverage requirement. If you go 63 days or more without creditable prescription drug coverage at any point after your initial enrollment period, you trigger a late enrollment penalty. The penalty is calculated by taking 1% of the national base beneficiary premium for each month you were without creditable coverage. For 2026, that base premium is $38.99. So if you went without coverage for 14 months, your penalty would be 14% of $38.99, which comes out to $5.46 per month, rounded to $5.50. Just like the Part B penalty, this surcharge is permanent. You'll pay it for as long as you have Part D coverage, even if you switch plans. And here's the kicker. The national base beneficiary premium changes every year, which means your penalty amount will fluctuate annually. If the base premium increases, your penalty increases proportionally. This creates a situation where the penalty you incurred years ago continues to grow in real dollar terms as the underlying premium structure changes. A 14% penalty might seem manageable today, but when premiums have doubled in 15 years, that same 14% represents significantly more money. The Part D penalty also has this fascinating behavioral economics element built into it. Unlike Part B, where most people either have employer coverage or they don't, Part D coverage comes in many forms. You might have prescription drug coverage through a retiree health plan, through the Veterans Administration, through TRICARE, or through an employer. All of these can potentially be creditable coverage, meaning they're as good as Medicare Part D and protect you from penalties. But here's the catch. Your coverage provider is supposed to notify you annually whether your coverage is creditable or not. If they tell you it's creditable and you rely on that information, you're protected. But if they fail to notify you, or if you don't understand the notification, or if your coverage changes and you miss the update, you could be accumulating penalty months without realizing it. I've seen cases where people had prescription drug coverage for years through a retiree health plan, and the plan was creditable for the first 5 years. Then the plan changed its formulary, reduced its coverage, and was no longer creditable, but the person didn't understand the notice they received. They continued with the plan thinking they were protected, and when they finally enrolled in Part D 2 years later, they discovered they had accumulated 24 months of penalty. That's a 24% surcharge, which on the 2026 base premium comes out to $9.36 per month, or $112.32 per year for life. The special enrollment period rules for Part D are also more restrictive than Part B. With Part B, you get an 8-month window after your employer coverage ends. With Part D, if you lose creditable coverage involuntarily, you get a 2-month window to enroll without penalty. 2 months. If you're on day 63 without coverage, you're already accumulating penalty months. This creates a timing trap that catches thousands of people every year. They lose their employer coverage, they know they need to sign up for Medicare, but they're dealing with retirement transitions, moving, family issues, and before they realize it, they've missed the 2-month window and they're into penalty territory. The other category of penalties that deserves attention is Part A, although this affects far fewer people because 99% of Medicare beneficiaries qualify for premium-free Part A through their work history or their spouse's work history. But if you're in that 1% who has to buy into Part A because you don't have enough work quarters, the penalty structure is even more severe than Part B. If you don't sign up during your initial enrollment period, Medicare applies a 10% penalty to your Part A premium, and you have to pay it for twice the number of years you delayed enrollment. So if you delayed for 2 years, you pay the 10% penalty for 4 years. If you delayed for 3 years, you pay it for 6 years. The base premium for Part A in 2026 is $565 per month if you have fewer than 30 quarters of coverage. A 10% penalty on that is $56.50 per month. If you delayed enrollment for 3 years, you'd pay an extra $678 per year for 6 full years. That's $4,068 in penalties for a 3-year delay. What I want you to understand is that these penalties aren't theoretical constructs designed to punish people for administrative errors. They're financial mechanisms with real mathematical consequences that compound over time and cannot be undone. When I look at the Medicare penalty system through the lens of rational decision-making, what I see is a structure that severely punishes incomplete information and delayed action. The system is designed to incentivize immediate enrollment during specific windows, and if you miss those windows without proper protection, you pay for it in perpetuity. Now, here's where we get to the practical question. How do you avoid these penalties? The answer requires understanding your specific situation and acting with precision during the correct enrollment windows. If you're approaching 65 and you're not working, or you're working at a small company with fewer than 20 employees, you need to enroll in Medicare Parts A, B, and D during your initial enrollment period. There's no benefit to waiting, and the risks are substantial. If you're working at a company with 20 or more employees and you have health insurance through that employer, you can safely delay Part B and possibly Part A if you want to continue contributing to a health savings account. But you need to understand that your protection lasts only as long as that employment-based coverage continues. The moment it ends, you have 8 months to enroll in Parts A and B and only 2 months to enroll in Part D without penalties. The 8-month window for Part B gives you some breathing room, but I've always believed in enrolling early rather than pushing deadlines. If you know your employment is ending in March, don't wait until October to enroll in Medicare. Sign up in April or May. The coverage will start the month after Medicare receives your application, or the month after your employment coverage ends, whichever is later. There's no penalty for enrolling early within your special enrollment period. There's only penalty for enrolling late. For Part D, the 2-month window is dangerously short, and this is where I see the most mistakes. People retire, they enroll in Parts A and B within their 8-month window, and they think they're covered. Then 4 months later, they realize they need prescription drug coverage, and they try to enroll in Part D, only to discover they've been accumulating penalty months since their employer coverage ended. This is entirely avoidable if you understand that Part D has a separate, shorter enrollment window. When your employer coverage ends, you need to enroll in Part D within 2 months, period. The documentation requirements are also important to understand. If you're claiming a special enrollment period based on employer coverage, Medicare will ask for proof. You'll need a letter from your employer or insurance company confirming the dates of your coverage and the reason it ended. You'll need to show that the coverage was based on current employment, not COBRA or retiree benefits. If you can't provide this documentation, Medicare won't grant you the special enrollment period, and you'll be subject to penalties based on when you should have enrolled during your initial enrollment period. I've seen people lose appeals because they couldn't produce adequate documentation of their employer coverage. Keep those documents. Keep the letters from your insurance company about creditable coverage for Part D. Keep your employer's confirmation of your coverage dates. This paperwork could save you thousands of dollars in lifetime penalties. There's also the income-related surcharge issue, which isn't a penalty but functions like one for higher income beneficiaries. If your modified adjusted gross income exceeds certain thresholds, you'll pay an income-related monthly adjustment amount, or IRMA, on top of your standard Part B and Part D premiums. For 2026, if you're filing individually and your income is above $103,000, or filing jointly above $206,000, you'll pay additional premiums that range from $68.70 per month up to $487 per month for Part B, depending on your income level. Part D has similar IRMA surcharges. These amounts are recalculated annually based on your tax return from 2 years prior, so your 2026 IRMA is based on your 2024 income. The IRMA surcharge can be appealed if you've had a life-changing event that reduced your income, such as retirement, divorce, or loss of income-producing property. But you have to file the appeal proactively with Social Security. They're not going to automatically adjust your IRMA just because you retired. You need to complete the form, provide documentation, and request the reconsideration. If you don't do this, you'll pay the higher RMAA amount based on your old, higher income, even though your current income is much lower. This is another example of the Medicare system penalizing inaction and incomplete understanding. What strikes me most about the Medicare penalty structure is how perfectly it illustrates the principle of irreversible decisions. In investing, we talk about permanent loss of capital as one of the worst outcomes. In Medicare, these late enrollment penalties represent permanent loss of financial resources. You can't make them go away through better behavior later. You can't invest your way out of them. They're a perpetual tax on a single mistake, compounded over decades. This is why understanding the rules before you need them is so critical. Once you're in penalty territory, your options are limited to paying the penalty or going without Medicare coverage, which is essentially choosing between bad and worse.